Professor Min, question for you, specifically pertaining to your testimony assigning principal blame to private label securitization as the proximate cause for the financial crisis. Why would the private secondary mortgage market not securitize subprime when the GSEs, in order to promote their affordable housing goals, were the largest purchaser of subprime and Alt-A mortgages during the exact time period that your testimony referred to, the 2004-2007 time period? I mean, if the government is churning that, why would the private secondary mortgage market not be securitizing subprime?
So I believe that the GSEs actually became the majority purchaser, I think starting in 05 or so when they convinced the regulator to do that. They also were the largest purchaser of Alt-A. That being said, the demand for AAA rated private label securities has been described by a lot of sources as, universally as almost infinite. That the AAA demand, because it offered a higher coupon yield than agency debt or treasuries and had that AAA rating that was seen as safe, and because it was then recollateralized in different markets like repos and derivatives and over-the-counter sort of transactions, there was almost infinite demand for it. So I don't think the GSEs contributed materially to that. A lot of people have written about that particular issue.
Well, you acknowledge, though, Professor, that there was a massive growth in the GSE's subprime portfolio during the time period that ran up to the financial crisis, correct?
Sure, and I think a number of studies have looked at that purchase amount. First of all, it's all AAA, and determined that that was not necessarily the driving cause of the demand. Really, the limiting factor on private label securitization was the equity and mezzanine tranches. You had to sell those to somebody, so that was the limit, basically. You could sell as much of the AAA stuff as you wanted. Someone was going to buy it, whether central banks, insurance companies, banks, et cetera.
Well, you talk about the devil you know versus the devil you don't know. We know, little editorial comment here, the devil that we do know is a system with GSEs that operated at a leverage ratio of over 200 to 1, well over 200 to 1, primarily because of the hybrid model that allowed politics to drive it instead of market-based underwriting decisions, where profits were privatized, losses were socialized, and where, as a result, the taxpayers were exposed to up to $200 billion. So that's the devil we know. Question for Professor Leah. Alex Pollock has pointed out that the long-term fixed-rate mortgage, while it's been described as consumer-friendly for obvious reasons, may not be so consumer-friendly in practice. As he puts it, consumers do not benefit if rates go down if they find that the values of their homes have fallen and they can't refinance because the long-term mortgages have effectively trapped them in their homes. Isn't there another problem, though, that comes about because the 30-year fixed-rate mortgage forces some borrowers to subsidize others because lenders can't charge prepayment fees? I think you mentioned that the absence of prepayment fees raises the price of mortgages by 50 basis points. If this is true, doesn't this force those who have no intention of refinancing or moving from their homes subsidize those who want that option?
Yes, in fact, the cost is socialized and spread through the mortgage interest rate to all buyers. And in fact, you do find that there are certain groups that are more prone to be refinancing, and that will, not surprisingly, be better off people that have equity and are going to refinance more often. So the contrast is to have a system where you pay for the option only when you exercise it. That's the European model, which applies prepayment penalties, not for the 30-year time period, but generally for the time the rate is fixed, which is oftentimes just 5 or up to 10 years.
Can we expunge from the discussion the phrase penalty? It's a fee for exercising a valuable option. Don't think of it as a penalty. Think of it as a fee for exercising a valuable option.
Let me just conclude. I've got a little bit of time left. Let me just conclude by asking kind of more general question for anyone who would like to chime in. And I'd like to inquire into the Federal Home Loan Bank model. We've been talking about, okay, beyond GSEs, what do we go to next? How do we have a vibrant, private sector-driven secondary mortgage marketplace that gives us a range of products for consumers, including the 30-year fixed-rate mortgage? What are your views on the Federal Home Loan Bank model in terms of driving, I guess, that secondary mortgage marketplace as a substitute to the GSE model? Professor Min, I'd like your thoughts on this, too.
I think it would create lots of liquidity. It's been a proven model. I'm not sure it would lead to 30-year fixed-rate mortgage broad origination because of that interest rate risk that would be held by the depository institutions that receive the advances.
I'm an interested party, Congressman, as you know, having run a home loan bank and invented their mortgage business. I think we do need to consider how the home loan bank, which is a GSE, but a much better kind of a GSE than Fannie and Freddie, could fit into this bigger picture. I'd be glad to come talk to you about that if you like.
Thank you. I yield back.